I mean, sure, gold and silver had a good week last week, and so did the mining stocks. But this week was the cherry on top. Gold finally hit a new all-time record high earlier today. We traded, I think, for the first time ever above 3,450. I don't think we quite closed above that level, just below it, but gold had a great week. It was up about 2.5%, over 2.5%. Silver had an even better week. It didn't hit a new all-time record high, but it did hit a new 13-year high. In fact, silver almost traded $40 an ounce. I think it got within about a nickel of 49. It closed around 39.80-ish. I forget exactly. In fact, I don't think they've settled it yet. I'm doing this podcast just after 4, and they're still trading. But it is a new 13-year high. This is a great close for the week and the day ahead of a holiday weekend. We've got the Labor Day holiday on Friday. In fact, I would expect a gap up in both gold and silver. I think by Tuesday, when American investors are back looking at the markets, I think that you could see a big gap up, whereas silver opens above $40 an ounce by Tuesday, and gold above 3,500. We'll see. Now, the gold stocks, again, as I mentioned on my podcast 2 weeks ago, continue to lead the way now. They're not being dragged behind like they were reluctantly, with investors completely skeptical of the gold bull and expecting it to die any day. Now, the gold stocks are leading. In fact, as of, I think, this week, gold was down about 2% during a time period where gold stocks were up 20%. Gold was just consolidating while the gold mining stocks were catching up. That's why I was hammering the table back in April, May of this year about buying the gold stocks, that was the best place to buy gold, was in the ground, because these stocks hadn't even moved yet. Well, now they're moving. And in fact, the GDX, which is the larger gold mining stocks, is now up over 87% on the year. This is shaping up to be the best year maybe ever. I mean, I guess if you went back to the 1970s, I don't know if this index, I don't think it existed back then. This is certainly the best year in the history of this ETF, and the year's not even over yet. I mean, I think that gold stocks are going to more than double as a group, which means some stocks obviously do a lot better than that if the average is a double. But right now they're up 86%, excuse me. It's the GDXJ, the juniors, that's up over 87% so far on the year. So these stocks are making a big move. The year-to-date gain on gold is now 32%. Gold is having a phenomenal year. Silver up 38%. But I think once we get above 40, we're going to make a beeline for 50. And then, as Katie barred the door once we're above 50. So don't wait. I've been hammering everybody on my podcast, on my X feed. I've been telling the guys at Schiff Gold, get on the phone, talk to your clients. They got to buy more gold and silver. And what I've been getting as feedback is that the clients have been reluctant to buy because they're worried about buying the top and they want to wait for a pullback. And I've been saying, don't wait for any pullbacks. You're not going to get any meaningful pullbacks. You just got to buy. Yes, you're buying the highs, but you're going to have to buy the highs or you're not going to buy. And the problem is the highs are going to keep getting higher. And so the longer you wait, the higher the high you're going to buy. So don't wait. In fact, remember when silver first moved above $30 an ounce, I was telling people that 30 is the new floor, that 30 on silver was like 2,000 in gold. And I was telling people when gold was at 2,000 and they were afraid to buy it because they thought it was the peak, I said, no, 2,000 is the new floor. So buying 2,000, 2,100, you're getting in near the bottom. People were afraid it was the top. I kept saying that this is a new day. This is a big bull market. you got to buy this level. And sure enough, we're almost 3,500. We're going a lot higher. Same thing with silver. Silver was 31, 32. I kept telling people, you got to buy it. It's not going to go much below 30 if it even goes below 30. So you're getting in close to the bottom. Now here we are knocking on the door of 40. Don't wait for 50, right? Yes, would it have been better if you bought it a couple of weeks ago? Sure. I tried to get you to buy it a couple of weeks ago. But if you didn't do it then, do it now, right? Why buy 50 when you can buy 40? And the move from 40 to 50, that's still a 20% gain. You buy $40 silver at $50, you got 20%. But 50 isn't going to be the top. It's nowhere near the top. In fact, I think once we get through 50, 50 will be the new 30. 50 is going to be the support for silver. You'll be lucky to be able to buy silver below 50. Right now, it's a double top from 1980 and 2011. That resistance is going to become support, just like $2,000 was the resistance in gold. From 2011 to 2024, it was resistance. It then became support, right? Resistance becomes support in bull markets. So we're going to blow through that double top, and 50 is going to be the new floor for silver. So get in now while it's a lot cheaper. Now, what is driving this? Why are gold prices, why are silver prices moving, right? For the reasons that I've been laying out for years now, but it's playing out right before your eyes on this giant stage. Look at what the Trump administration is doing to the Federal Reserve. I mean, up until now, they've at least had the pretense that the Fed was independent. Now, I've said that this was all BS, that there was no real independence, that behind the scenes, they were working hand in glove. Well, Trump dropped the pretense. He is now making it obvious to everybody that the Fed is political. He is stacking the Fed with his own cronies. He is coming up with dirt on people so he can fire them, so he can replace them with his own cronies. And he wants to move interest rates down. Why does he want to move interest rates down? He tells you, because we can't afford the rates. He says the U.S. government needs to save money. We need to cut back on our interest expense. He says the housing market can't handle these high mortgages. We need lower interest rates so people can afford to buy houses, right? So we're too broke for the interest rates that we have now, except the interest rates that we have now are low. They're just not as low as they used to be. And because we have so much debt, we need those super low interest rates. But the problem is those super low interest rates aren't going to work for our creditors. The people that are loaning us this money aren't going to keep loaning us money if rates go down. And in fact, when Powell cuts rates, I think long-term interest rates are going to rise. And that is going to really upset the Trump administration, because the sole purpose of cutting short-term rates is to remove or is to lower long-term rates. Well, the last time the Fed cut short-term rates, long-term rates went up. That's one of the reasons they stopped cutting, because they didn't want to put any more upward pressure on rates because rates are too low. And lowering them further is just going to unleash more inflation. But what's really going to unleash the inflation tsunami is going to be when the Fed goes back to QE, because that's exactly what a Trump-stacked Fed is going to do when the rate cuts don't work. When the rate cuts cause long-term interest rates to rise, then the Fed is going to have to start buying those bonds, because the world is not going to want to buy them, because they're going to see through the charade. If inflation is going up and the dollar is going down, why are foreigners going to want to lend us money? Why is anybody going to want to lend the U.S. government money? The U.S. government is telling all the creditors, we don't give a damn about you. We just want to lower the interest rates we pay you. As we debase the dollars, we pay you in. So people aren't going to want to buy the treasuries at the lower rates. So the only buyer is going to be the Fed. And the only way to do that is to create inflation by printing even more money. By the way, the dollar index closed the week down again, back below 98. I think it closed around 97.80. And yields on U.S. treasuries rose on the week. They didn't rise a lot, but look at the yield on the 30-year treasury at 4.92%. That's almost as high as it's been. I mean, the highest it got in the immediate aftermath of the Liberation Day sell-off was just above 5%, just barely above 5%. Now, the 10-year has recovered more. The 10-year got just above 4.5, and it's down at 4.23. But we've gotten a widening of that yield curve between the 10s and the 30s because higher inflation expectations are being built into the markets. But those expectations are going to be built in even higher once the Fed starts cutting rates, because the economic data argues for the opposite. Look what we got today. We got the trade deficit that just came out today. I think, what was it, July number, but it soared to 103.4 billion. I think it's the second worst monthly merchandise trade deficit ever. I think the only time it was worse is in the COVID reopening days in 2022. But throw that out, despite the tariffs, the trade deficit is surging. And what drove it there was I think a 6 or 7% spike in imports. Exports went down despite these tariffs that are supposed to reduce the trade deficits. They're getting bigger. The budget deficits are getting off the charts bigger. So the twin deficits are increasing, and all of this is bad for the dollar. The dollar's going down, and that means gold prices, silver prices are going up. And I think the fact that you're getting the movement that we're seeing now in these gold mining stocks, they're going up on days that gold is down. And when they sell off in the morning, they rally and they close up. So there are buyers. There are big buyers for these stocks. Why? Because the institutional investors are finally realizing how cheap these stocks are. And they finally are gaining some confidence in the longevity and stability of the gold bull market. Even if gold stays where it is, these gold stocks are cheap. Investors have been afraid that gold was going to crash, and so they stayed away from these stocks. Now I think they're coming to the realization that gold's not going to crash. It's the dollar that's probably going to crash. So they're buying these stocks, but they still haven't accepted the reality that the gold price is going much, much higher. And again, so will the silver price. Once they accept that reality, then they're really going to get aggressive in the buying of these stocks. But one of the kind of negatives of the gold bull market was the failure of the gold mining stocks to confirm the bull market. I've been hearing this for years, that this lack of confirmation shows that the gold market bull is running out of steam, because the thought process was the stock market investor is forward looking. So the stock market investor is not looking at today's price of gold, but at the future price of gold, and using that future price to discount the expected earnings of the gold mining companies. So the fact that the gold stocks were weak meant that investors expected that gold price to go down. And so you had this negative sentiment. Now, what I was saying all along is, well, you know what? I think that's bullish, because it shows that there's no confidence in this bull market, so it's going to keep on running. And it's been doing that the whole time. The gold has been going up. Gold's been going up for 25 years. Gold's done better than the S&P 500. Just buying an ounce of gold and hiding it in your underwear drawer, I think it's about a 9% or so compounded return for 25 years. I mean, it's better than the S&P 500, even if you reinvested your dividends over that same period of time. And gold is just a metal. So the whole time gold's been going up, the gold stock investors have been saying, it's not going to stay up. It's going to come down. It's a bubble. It's all short term. It's because of this or because of that, but it's going to come down. Now, investors are starting to wake up that this rally is real. Now, that doesn't mean it's anywhere near over, because we still have the majority of institutional investors to realize this. We've just got a small group of people realizing that this has happened. If you look at gold and silver and mining equities as a percentage of what typical investors have. I think it's about 0.5% of all the investment capital in the US is allocated to gold, silver, and mining stocks against a historic average of about 2%. But the reason that the average is so low is because most people have no exposure. Most institutions have no exposure because I think the people that understand the gold story have a lot more than 2%. They may have 10 or 20%. Look at me, I'm like 60%, right? So there are a lot of people who get it that are way overweighted. So that's the reason it's 0.5%. It's because so many other institutions and individuals have zero weighting. They don't own an ounce of gold or silver. They don't own a share of a gold or silver mining stock. And that means there is a, tidal wave of buying that is going to come into this market. And it doesn't take much to lift it. But just to revert to the mean of 2%, 2% of the assets in the precious metals, physical and mining, would mean a fourfold increase in demand, which is not going to be met by an increase in supply, not even close. So this is just early, right? Eventually, sure, there will be rampant enthusiasm among individual retail investors, but we're not even close to any kind of euphoric blow off. It's nothing like the enthusiasm that you see in crypto and Bitcoin. And by the way, Bitcoin year to date is only up about 15%. So that's half the gain of silver or of gold, and even less when compared to silver. Yet gold and silver didn't get anywhere near the hype that Bitcoin got. Bitcoin got all the help from the Trump administration, all these new Bitcoin treasury companies buying up Bitcoin. And despite all that buying, you only have a 15% gain, which could evaporate very quickly. Whereas the real money is being made in gold and silver. It's been mainly driven by the central banks because the central banks don't like what the Fed is doing either. They don't want to hold dollars as a reserve if the Trump administration is going to compromise what's left of the pretense of Fed independence and lower interest rates and offer a yield on U.S. treasuries that is lower than the rate of inflation, that is much lower than the rate of dollar depreciation. Why do our creditors want to lose money? Why do they want to accept an interest rate that doesn't even cover their annual loss due to the foreign exchange, let alone what it's doing to the underlying value of the principal that they would get paid back? So foreign central banks are moving out of U.S. dollar reserves and into gold. And more central banks that haven't done that yet are going to be joining the get out of the dollar parade. And right now, central banks have been walking away from the dollar. But as the dollar's decline accelerates and gold's rise accelerates, they're going to run from the dollar and they're going to run to gold because that's where you go. No, for years, when I was warning about the dollar's days as the world's reserve currency being numbered, people always said, well, Peter, there's no alternative to the dollar. Look at the euro, look at the yen. Yes, the dollar may be a dirty shirt, but it's the cleanest one in the hamper. My response was always, that may be true, although it may not, but there's one alternative that isn't even in the hamper, and that's gold. Gold is squeaky clean. It's outside that hamper full of dirty shirt currencies. Gold is real money, and that's what central banks are buying. Not only do they want protection from inflation and a Fed that's been compromised and is lowering rates when the market should raise rates, but the government can confiscate their dollars through sanctions, right? So not only are your dollars going to lose value, but we reserve the right to take them away from you whenever we want. So gold allows central banks, foreign governments, to reclaim their sovereignty, to escape the U.S. inflation tax, but also to own a reserve asset that doesn't have a counterparty risk with the U.S. government. You're a central bank and you've got gold in your own country, in your own vaults. You own it. I mean, the only way the U.S. can take that from you would be to physically invade you, right? We'd have to send troops on the ground to get their gold, which isn't going to happen. I mean, we could take their treasuries without doing anything. So they don't want them, right? Not only are they low yielding, but we've shown what we could just take them away. So this whole thing is over. The dollar's reign as the king of currencies, this whole US dollar hegemony is coming to an end. And nobody is paying attention to it. The mainstream financial media barely even covers the price of gold. Yeah, they mention it once or twice. They might have one guest on who will talk a little bit about gold stocks, and then they'll say, "Well, is it over yet? Is it too crowded of a trade? How can it be crowded when no one's there?" Right? So you need to be moving money into this. Don't even wait. Again, don't wait until the weekend is over.
Gold and silver have once again captured the spotlight as America teeters on the edge of unprecedented financial and political instability. With Donald Trump's recent surge in polling numbers despite multiple legal challenges, and the U.S. economy walking a tightrope of inflation, rate uncertainty, and record-breaking debt levels, it has become abundantly clear that the fiat system, rooted in endless money printing and blind trust, is broken. Gold and silver are not just alternative investments anymore. They are lifeboats in a storm of economic and institutional collapse. Every fiat currency in history has eventually failed. The US dollar, once backed by gold, now floats on the whims of policymakers and central bankers. The Federal Reserve claims to fight inflation, yet it created the very problem with years of near-zero interest rates and trillions in stimulus. And now, with CPI inflation numbers still sticky and consumer sentiment in freefall, they've cornered themselves into a lose-lose situation. Raise rates and tank the economy, or ease and ignite another inflation wave. Either way, fiat suffers. But physical gold and silver, finite, real, and time-tested, thrive. In the last few weeks, silver has quietly outperformed many other assets, pushing past key resistance levels while being largely ignored by the mainstream media. Gold, too, is testing all-time highs amid global central bank accumulation. Why are nations like China, Russia, and even Poland buying tons of gold while telling their citizens to hold cash? Because they know what's coming. They know the dollar is losing its dominance and that the next financial system won't be built on paper IOUs. It will be anchored to something real. Trump's return to the headlines isn't just about politics, it's about economic sentiment. His recent statements slamming the Federal Reserve and calling for a return to sound money are echoing louder than ever. Trump understands that Americans are losing faith in the institutions that manage their money. Confidence in the Fed is near all-time lows. The Treasury is issuing debt at a breakneck pace. Social Security is on track to go bankrupt. Meanwhile, the stock market continues to float on speculation, artificially supported by Fed jawboning and tech hype. But beneath the surface, cracks are forming, young investors are waking up. They're beginning to see the trap. Save in dollars, and you're guaranteed to lose purchasing power. Trust in stocks and crypto, and you're subject to manipulation and regulatory whims. The only assets with a 5,000-year track record of preserving wealth through every war, recession, and regime change are gold and silver. And right now, silver is arguably the most undervalued strategic asset on Earth. Not only is it a monetary metal, but it's also essential in solar panels, electric vehicles, and industrial applications. The supply is shrinking while demand is surging. This is not a speculative narrative. It's a supply chain reality. Meanwhile, America is sleepwalking into another debt crisis. With over $34 trillion in national debt and interest payments now rivaling military spending, the writing is on the wall. The government has no plan to pay it off. The only tool they have left is inflation. Silent theft through currency debasement. If you're holding dollars, you're the victim. Every printed dollar makes your savings weaker. Every stimulus check, every bailout, every new government program funded by the printing press, it's a transfer of your wealth to the state. Look at the banks. Regional banking stress has returned, and big names are warning of a new wave of collapses. If even one major institution falls, a domino effect could ensue. And with FDIC reserves under pressure and trust in banks declining, people are beginning to ask serious questions. What happens to my savings if the system locks up? If you can't hold it, you don't own it, and that's why physical metals are making a comeback. Gold and silver require no counterparty. They cannot be hacked, frozen, or inflated away. They don't rely on government promises or Wall Street gymnastics. In times of war, regime change, or collapse, like the world is inching toward now, they are the final fallback. Just this week, Trump warned that America is closer than ever to losing the dollar as the world reserve currency. That's not alarmism, it's fact. The BRICS nations are actively developing a gold-backed trading currency, and the world is watching. The petrodollar era is ending, and with it, the dollar's dominance. Gold and silver will outlive fiat. They have outlived every empire that thought it could print its way to prosperity, and they will outlive this one too. While Wall Street distracts you with AI stocks and debt-fueled bubbles, the smart money is quietly accumulating hard assets. If the monetary system resets, and history shows it always does, those holding metals will have purchasing power while everyone else scrambles for crumbs.